February 26, 2022. 3 days into Russia's invasion of Ukraine, the United States and its allies do something no coalition has ever done to a major economy in peacetime. They cut select Russian banks out of SWIFT, the messaging system that quietly runs almost every international payment on Earth. Days later, they go further. They freeze $300 billion in Russian central bank reserves, money that was supposed to be untouchable, sovereign, off-limits no matter what. The ruble collapses, loses half its value in days. Western officials are confident. This is it. Weeks, maybe. The Russian economy strangles itself from the inside, and the war ends not on a battlefield, but in a banking system. 6 months later, the ruble is back where it started. Something didn't just fail to work as planned. Something deeper happened, a warning shot that the entire world heard, whether or not it was aimed at them. And the country that fired it may have just accelerated the decline of the very weapon it was trying to prove it could use. Here's what most people don't understand about American power in the 21st century. It doesn't run primarily through aircraft carriers or troop deployments anymore. It runs through plumbing. Financial plumbing, dull, technical, invisible, that most of the world never thinks about until the day it gets shut off. The United States dollar makes up roughly 58 to 60% of global foreign exchange reserves. It's involved in the vast majority of international currency transactions. And critically, it clears through American banks, meaning that virtually any international payment of consequence, at some point, touches a system the United States can see and can control. This isn't an accident of history. It's the product of decades of accumulated trust, deep liquid markets, a legal system that protects property rights, and a network effect so powerful it becomes self-reinforcing. Countries hold dollars because other countries hold dollars. Everyone accepts them because everyone else does. It's a monetary monopoly built not on force but on convenience, which is exactly what makes it so easy to forget how much leverage sits underneath it. And for decades, the United States used that leverage carefully, surgically. Targeted sanctions here, an asset freeze there. Enough to signal resolve, not enough to make the rest of the world seriously question whether the system itself was safe to depend on. Then came Russia in 2022, and the United States didn't use a scalpel. It used something closer to a demonstration of raw capability, and a demonstration, once made, cannot be unmade. Every central bank on the planet was watching, not because they cared about Russia, because they suddenly understood something about their own reserves that they hadn't fully internalized before. To understand why the 2022 sanctions were so extraordinary, you have to understand the actual mechanics of how this leverage works. Because it isn't one tool, it's a stack of them, each closing a different escape route. First, SWIFT. It doesn't move money. It moves the instructions to move money, the messaging layer that tells one bank to pay another. Exclude a country's banks from SWIFT, and you don't destroy their money. You destroy their ability to tell anyone where to send it. Suddenly, routine international payments, the kind that keep an economy running day to day, take weeks instead of hours, if they happen at all. Second, correspondent banking. Most banks in the world don't have direct access to major currency clearing systems, so they route through larger banks that do, concentrated overwhelmingly in New York and London. That concentration is a choke point. Pressure the correspondent bank, and you've effectively pressured every smaller bank downstream of it in countries that never signed onto the sanctions at all. Third, and this is the one that gives American financial coercion its true global reach, secondary sanctions. The U.S. doesn't just say, "We won't do business with sanctioned entities." It says, "If you do business with them, we won't do business with you." A European bank, a Japanese trading company, a Chinese state enterprise, none of them are American. None of them answer to American law in the traditional sense. But they all need dollar access to function in the global economy. Given the choice between a sanctioned partner and access to the American financial system, they choose access. Every time. That's not law enforcement, that's leverage, functioning through pure market gravity. Stack all three together, and you get what happened to Russia. Asset freezes that made $300 billion in reserves instantly useless. Legally still Russian property, but functionally worthless because Russia couldn't touch it. Swift exclusion that turned routine trade into a logistical nightmare. And secondary sanctions that made even sympathetic third countries think twice before helping. This is, by every technical measure, the most powerful economic weapon on Earth. And in February 2022, the United States pointed it at a major economy and pulled the trigger harder than it ever had before. Here's where the story stops being about Russia and starts being about everyone else. The Russian economy didn't collapse. It adapted, and did it faster than almost anyone predicted. The central bank hiked interest rates to defend the ruble. Capital controls stopped money from fleeing. Energy exporters were required to convert foreign revenue back into rubles, artificially propping up the currency's value. Within months, trade rerouted toward China and India, settling in yuan and rupees instead of dollars. A domestic alternative to SWIFT, built years earlier, almost as an afterthought, suddenly became load-bearing infrastructure. By mid-2022, the ruble wasn't just stable, it was stronger than before the invasion. That's a tactical story about Russian resilience, but it's not the important story. The important story is what every other country was doing while they watched this unfold. Because the actual lesson of the 2022 sanctions wasn't, Russia is resilient. It was this: sovereign reserves, the money a country holds specifically as insurance against catastrophe, are not actually safe from seizure if you end up on the wrong side of Washington. That is an earthquake of a realization for a central banker. The entire point of holding reserves in dollars is that they're supposed to be the safest, most liquid, most politically neutral asset in the world. A rainy day fund that no one can touch. If that assumption breaks even once, even against a country you have no sympathy for, every other country holding dollar reserves has to ask itself, could this happen to us? And they didn't just ask. They acted. Central banks around the world accelerated gold purchases, gold being the one reserve asset that has no counterparty, nothing to freeze, nothing that depends on anyone else's goodwill. China kept pushing its alternative payment infrastructure. Countries with no direct conflict with the United States, Saudi Arabia, India, dozens of others, began quietly diversifying reserves they'd held in dollars for decades, not out of hostility, but out of pure risk management. This is the mechanism the manuscript calls the strategic contradiction sitting underneath the entire system. The same dollar dominance that makes financial sanctions so devastating is the thing that gets eroded every time those sanctions are actually used. Every demonstration of the weapon's power is also a demonstration of its risk. And risk, once priced in, doesn't go away. It compounds. Here's the part that should genuinely unsettle you. The United States can't actually calculate this cost in real time. The benefits of sanctioning Russia were immediate and visible. Headlines, political credit, a clear signal of resolve. The cost, a world slowly, quietly reducing its dependence on the dollar, is slow, diffuse, and won't show up as a crisis for years, maybe decades. Which means the people making the decision to use this weapon today are not the people who will have to deal with the consequences of it losing its power tomorrow. That mismatch is exactly the kind of incentive structure that leads a country to overuse the most valuable tool it has, right up until the moment it isn't valuable anymore. So where does this actually leave the United States? Not powerless. That's not the argument here, and it would be a lazy one. Dollar dominance rests on decades of accumulated trust, genuinely irreplaceable capital markets, and network effects that don't unwind overnight. There is no serious alternative reserve currency waiting in the wings. The euro carries its own structural weaknesses. The yuan is constrained by capital controls that China shows no willingness to abandon. This is not a story about the dollar's imminent collapse. It's a story about erosion, slow, compounding, and largely invisible until it isn't. Every sanctions episode that demonstrates the reach of this system also demonstrates its risk, and every country watching adjusts its behavior at the margins. Reserves shift a percentage point here. A new payment system gets a little more investment there. None of it is dramatic on its own. All of it adds up. That creates a genuine strategic dilemma for whoever is sitting in the U.S. Treasury Department a decade from now. How do you keep the most powerful economic weapon in the world sharp without using it so often that you talk the rest of the world into building an alternative? There's no clean answer to that question. It's a trade-off every administration will have to make, usually under pressure, usually with incomplete information about how much erosion has already happened. What this episode should leave you with isn't a prediction about when the dollar loses its throne. It's a sharper way of watching the news the next time a major sanctions package gets announced. The headline will tell you what cost is being imposed on the target. It almost never tells you what cost is being imposed on the system doing the imposing. Everything you just watched, the mechanics of SWIFT, the correspondent banking choke points, the way secondary sanctions turn foreign banks into de facto enforcers of U.S. policy, that's the actual architecture of economic coercion. It's one tool in a much larger toolkit that includes trade wars, export controls, investment restrictions, and energy leverage. And I break all of it down, how it's built, why it works, and why it so often backfires in Economic Statecraft, a practical guide to sanctions, trade wars, and financial coercion in the 21st century. And if this particular episode, the dollar weaponization piece specifically, left you wondering what actually happens if this erosion keeps compounding, that's a question I go even deeper on in a companion book, The De-Dollarization Dilemma. Both links are in the description.